we're getting all set up here. So welcome everyone to Trading Coaches Playbook. Hopefully you can hear me pretty well and see my screen and probably see me too, obviously on the camera here. So good morning, Stephen. Good morning, everyone. Welcome, welcome, welcome. And got a nice little group forming here. So recognize a few of the names from previous workshops and students. So I want to welcome everybody here and good afternoon, depending on where you are, obviously. Morning, if it's there. So we'll go ahead and kick this off. Before we do get started, though, I need to remind you we're not investment dealers or investment advisors or brokers, registered broker dealers. Can't even speak today. Sorry. I swear I'll be okay. Anyway, so we're not investment advisors or broker dealers, and we're going to look at all this stuff from an educational standpoint only. I'm not telling you to buy, sell, or hold any particular securities or give any personalized recommendations about the markets. There's always risk involved in the markets. Nothing we can do to eliminate the risk. We can just try to manage it and deal with it. Let's see what else. Oh, we're also not subject to trading restrictions, so I could have a position in a security or initiate one at any time. Sorry, just putting my watch on. It was off and not wound. So good afternoon, Kevin. Good morning, Helen. And we got a lot of workshops, a lot of things going on here at Wealth Builders HQ, as you can see on the screen. Keep us very busy. Myself, I'm pretty busy running a few programs that I have. You got the E-mini think tank, where I'm in there 3 days a week, but I work a little bit more than just that. The 3 days a week, I meet with my students from 9 a.m. to 11 a.m. on Monday, Wednesdays, and Thursdays, and we dissect the futures markets. We look for trading opportunities and learn how we can attack those futures markets from a directional standpoint. And then, of course, there's the Wealth with Spreads program, where we are looking at delta neutrality, meaning we're not really caring which way the markets go up or down. What we're doing there is taking advantage of mispricing or changes between two related securities. So we're trading spreads on futures. Now, it's not options, it has nothing to do with options. And again, it's just trading one future against another for the price change. And it's kind of neat. You reduce risk, you give yourself additional opportunities in the markets. The SPX cash flow program, that is options. Basically, we're looking at day trading some options to get a little bit of premium every single day on the weekly options that expire on the SPX at the end of the day. So it's just taking advantage of some short-term moves in the markets on a regular basis. And if you're brand new to trading, that's the futures boot camp at the bottom that you can get involved in. If you're interested in any of those programs, best thing to do is probably email us and let us know. We can get you all set up or give you more information about it. You can hit up support at wealthbuildershq.com. Put that in the chat for everybody there. Anyway, we're going to dive into an educational session today. Now, I'm not going to be able to cover every little piece of this. I mentioned the E-mini think tank. If I go over there, I'm logged in right now to my members dashboard. In the E-mini think tank, which is where I spend most of my time. Actually, that's not true. I guess some of the live trading sessions, but there's a lot of bonus materials. There are educational videos that teach you a lot of the ins and outs of the markets and the different ways of trading those markets. Additionally, there are documents here that will support that. If I don't just teach you something, I want to show you how to use it in all market environments. So not only do we learn it, we get the documents to help support and reinforce that learning. And then during the live sessions, which are all recorded, you get to actually see it being used in the live markets, specifically in the futures in this case. But we can use this point and figure in pretty much anything you want. And of course, at any time, if my students need to get a hold of me, they just send me a message. And I get back to them as soon as I possibly can, which is pretty quick because they tell me if I don't get back quick enough. Hello, Brenda. Welcome. So anyway, that's, again, there's a lot of stuff here in the E-mini think tank, and, whatever you're into, let me know and we'll see what we can do for you. We have other instructors that teach other things. You can also stay in touch with us, obviously, through all the socials, right? I've got my own Twitter, which is at TraderBDub. So you can hit me up there. I usually tweet pretty much every day. There I am on Twitter and LinkedIn, all that good stuff. You can also, again, see what's going on everywhere in the company with that. So as I mentioned, we're going to talk about point and figure charting, which is kind of the original style of charting. When you go back to the originations of the trading floors, at least in America. I say the original style of charting, it's for the US or Western world. If you go back far enough, you got other styles of charting, like candlesticks, believe it or not. They were created in the 1700s in Japan. But in the US, when they were forming the New York Stock Exchange and the trading floors, Philadelphia Exchange, Chicago, all those, they were using this style of charting. And it's nice because it takes time out of the equation. And it also filters out a lot of noise. That's been a problem for many people, especially right now in the markets. If we go out and take a look, I didn't look to see where we are right this moment, but here's the S&P futures. And I mean, look at this, back and forth all morning. So where's the open? It's probably this candle. Nope, it's back further. It's this candle right here. So from the open, we haven't really moved much, just slightly down. But as a day trader, obviously, we've been all over the place, right? We were down, we were up, or down, we're up. I mean, this has got more personalities than Sybil, right? This market is crazy. And I think we bounced off of a 60-minute demand, if I'm not mistaken. Go back there a little bit further. Yep, there it is. At 41.24 to 35, that was a 60-minute zone that I identified. And that's where we bounced from. And I even tweeted that out today for those of you who caught that. I said we're going to bounce off that 60-minute demand, and we have. As a matter of fact, let's see what the momentum looks like. I am on 60, sorry. Yeah, we had what's called a positive divergence. It's a clue for momentum. My whole point about this is there's a lot of noise. And if you're looking at bigger time frames in the markets, and by the way, bigger time frames usually lead to bigger profits. It also increases risk, but you can compensate for the risk by trading smaller size. When it comes to the futures like this ES, you could trade micros, or you could trade 1 micro. You have limited risk, right? If you go bigger in time, you can reduce risk by size or by the number of trades you take. That's another way of reducing risk. Basically, I've talked about this before in risk management, which I did in Trading Coaches Corner. You can find some of those on YouTube, though, the old videos, by the way. But when it comes to risk management, you never hear enough of that. Believe me, it's probably the most important thing is protecting your money. I know everybody wants to learn how to make more money, but if you don't protect what you don't have anything to trade with. So this is paramount. This is the most important thing. And number one is size. And that's the type and number of the securities you trade. You move that back over so we're not off the screen there. So like I said, you could trade micros, you could trade minis, you could trade full-size contracts, or Forex, it could be micro lots, mini lots, shares of stock, whatever it is. Number two is time, or I call it duration. And that's basically the time frame that you're trading on. So if you go to higher time frame charts like weeklies, dailies, quarterlies, monthlies, whatever they are, you're going to have bigger zones with more risk. And you should also have the zones further away so you get more profit, right? Your target's going to be further away, your stops will be further away. And then finally, the last one is frequency. And that's the number of trades you take. The more trades you take, the less selective you're being, and the more likely you are to take bad positions. But if you are more selective, there's no reward for taking more trades. The only person that makes tons of money when you overtrade is your broker, right? So, or the market makers, if they're taking advantage of the spread on you. So for the most part, we only want to take high quality opportunities that we find that fit our rules. And yes, you should have rules that you follow when it comes to trading. So we can adjust any one of these to compensate for another. So with point and figure charting, yes, you could go to small time frames, hypothetically. I mean, really, it's not based on time, but you could go down to what you would see as an equivalent to an intraday chart. And if you wanted to, you can increase your size for that. But if you go to a higher time frame, bigger boxes, which we'll see in a moment, then you want to reduce the size or reduce the frequency of trades to compensate for the additional risk. So any one of these three can be adjusted to find the risk tolerance that suits you best. And everyone's different. So you got to find what works for you. So we're going to talk about that. And this is pure price action. This dates back to the late 1800s for point and figure. Basically, I mentioned it was the first charting technique used in the Western stock markets. And what happened was that, traders on the floor actually started off, I think it was called the buttonwood tree, because the buttonwood tree accord is what they used to start the New York Stock Exchange. So when they were circling around the tree, trading shares with other people, if they're trying to keep an eye on prices, they would write them down. Or eventually, when the exchange started, they would create like a graph, graph paper, with the grids, and they'd write down the prices and check them off when you got to a certain price level. So you'll see this. Let's see, where am I here? Just checking. Okay, yeah, actually, that's where it was in the next piece. Yeah, basically, it was created out of necessity because people wanted to kind of track what was going on with the prices. And you could look up Wyckoff. R.D. Wyckoff has a bunch of books on this, on price action. I'm not sure which one's the best. Don't ask me. I know a lot of people want to know what's the best book to read. Read them all and figure out yourself. That's kind of what I did. I haven't read it in quite a while. I do use this from time to time, especially when the markets are choppy the way they are now. So that way I don't get whipsawed back and forth, and I can identify better what the overall trend is. And I see this every now and then on Twitter as well, with other traders posting some of the point and figure data to kind of weed out the quick back and forth, the noise, if you will. So basically, when you have a chart, the x-axis, the one on the bottom, the bar or candlestick charts use time. Okay, we don't do that here. Okay, there is no time. And what happens is, even if there's not a change in price, they have to put a new bar or new candle for every time period that goes by, right? So sometimes you'll see just dashes where there was no trade and there was no open or close price technically, but the bid price that was there is whatever, nobody bid on it, nobody bought it, nobody sold it. So they have to still report price as time goes by. Point and figure only looks at where the actual trades have occurred. And that's really what's most important anyway. Where are people coming to a consensus? Where are they willing to buy? Where are they willing to sell? Period. So this does not account for time at all. Excuse me, sorry about that, bad allergies. And basically with a point and figure chart, if there's no price change, there's nothing shown on the chart. So you're not going to see if this is just going sideways or if it doesn't move enough. Again, you get these small wiggles throughout the day. If you're filtering out those small wiggles, you won't even see them. So you don't have to be bothered by the noise. You can stay in a trade longer by riding the higher time frame trend that's going to lead to bigger profits. And you can find better quality opportunities this way. You really can. Volume is not recorded separately. Basically, a lot of people will put in the volume underneath. You get that little histogram like this, or you can use an area chart, whatever you want. But a lot of people do that with candlestick charts or bar charts. Basically, volume is really reflected in the amount of price changes when it comes to point and figure. So if you're seeing a lot of price changes, it could be leading to higher volume. And you'll see it both. When I say price changes, I don't mean reversals. Okay, it could be the price changes in the same trend direction. That also is a reflection of increased volume typically. So everything gets incorporated right into the chart. You don't have to chart things separately. You don't have to guess. You don't have to worry about time. It just becomes a little bit easier once you get used to reading these. And they can even present you with price targets, which is kind of nice on the patterns. So first you got to figure out, this is a point and figure chart. And I think I can go right here. Let me see if I can change it on this. Forget exactly where it is on this platform, but I will find it because I know they have it. General settings. No, it might be under price actually. No, I know I found it the other day and now I forget where it is. So that's open, high, low, close. I apologize. I should know this better. Oh, wait. It's right at the top, right there. I knew it was something easy. I also have TradingView, which I use too. This is called Omega Charts, which is a platform that we use in class quite a bit. It's very nice. And you could choose your brokers. It's just a software, basically. But right here, I click on, there it is, the point and figure right at the top, and I have to choose what the box size will be. And I can either use points or I can use number of ticks. There's going to be 2 data points you need to put in, box size and reversal. So right now, I'm going to put in, let's just do 50. It lets me do that. And there we go. So obviously it starts to look a little bit different, doesn't it? And notice the time on the bottom. It's a much, much different picture of price action, right? And supply and demand will look different as well. Everything will look a little bit different, but again, it's going to be smoothing out the data quite a bit. So right now we're looking at that point and figure. If I go back again to say a daily chart, not in bar, but in candle perhaps, you can see that, yeah, we have this nice uptrend going on, but it's looking a little bit choppy at the end as well. And when I go back to the point and figure, I don't know why it keeps changing that, but there we go. Yeah, why is it going 200? I'm trying to figure that out. It doesn't look like 200 points. No, that's right. It's 50. It's doing it right. Anyway, it gives you a different view of price, as I was saying. And we can see that the price is slightly moving up, but a little bit choppy. Okay. Anyway, let's move along here. You got to determine what kind of box size you want. You know, you could use $1 per box. It depends on the price of the security. Okay. And I'm going to get to it in a little bit, but typically you want to use roughly 2% of price. So we were looking at a $4,100 index. That means that the box should be about 82. Well, we're not going to use 82. You're going to round off to the nearest decade if you want, or 50s, you know, 50, 100, 150, 200, depending on how big the price is. So I could do either 50 and by going down, or I could go up to 100. And if I change my box, let's try this again. There we go. We do 100. The bigger the box, the less data points you're going to see, but you're going to see a longer time frame trend. And you can definitely see this looks like a mess right now. Okay. Anyway, actually, you know what I'm going to do, I think, is go over to this. Yeah. And where's my point and figure here? There it is. And let me see, let me change it here. Settings. Scales, is that it? No. I apologize. I don't know where the setting is on this one either, because it should allow me to change the settings for the price right here on the boxes. Appearance. Well, it's margins. That's really weird. It should be easy to find. And of course, I can't under pressure. And it should not be by minutes. I'm not sure why this is doing this by minutes right now. Let me refresh real quick. And where the heck is the setting? I might have to go somewhere else, because right now, saying PNF, ATR, oh, it's using average. That's why I found it right there. Box size. That's what I wanted. So again, I could do 100. And I'm just going to do one box reversal for now. There we go. That's what I was looking for. Sorry. And you can see that with the 100, it is a much more spread out chart versus when I go to the 50. Now each box is 50 points of movement, and we're going to get a lot more data. So it just depends on what you want to look at. Again, if I want to go intraday, because this is definitely longer term, I would drop down the price number for the boxes. Let's say I do $10 or 10 points for each box. Now we're going to see a lot more detail. And we're not quite at an intraday chart, close to it though. Probably similar right now to maybe an hourly chart. And you notice the time is not symmetrical at the bottom. Okay. Anyway, let's move on here a little bit. If you see an X, that represents prices going up. If you have an O, that represents prices moving in a downward direction. Okay, so pretty simple. X is moving up, O moving down. So we also need to figure out, okay, what is going to tell us that prices are stopping the movement that they're currently in and reversing? So you have to determine what is called the reversal size. So not just the box size, but the reversal size. And basically the reversal distance is the box size times the reversal amount. So you can do whatever variations you want. For instance, if I go back to my chart here, notice I went to traditional, box size 10, reversal amount 1. That means if prices move down and trade 10 points below the high they were at, I will get a new row. I'll get a new O in the next column. For instance, let me clean this chart up here. Remove drawings, there we go. You can see I had an X. If prices moved up by 10 points, but then we moved down by 10 points from the beginning of that X, and I got a no. The only way I'll get a new X is if we go 10 points up from the beginning of this O, which means we got to go from about 41.50, 50 to 41.60. That's the only way I'll get an X over here, is if the price moves up by 10 points. Otherwise, if price moves down by another 10 points, I'll get another O. Now, if I change the reversal amount, watch what happens with the chart. Right now, we only need 10 points the other way for prices to give us a new column in reverse. But if I change this to 3, I actually need a 30-point reversal before we even see the trend change. And notice what it did. It gave us less X's and O's, less columns, and it smooths out the trend a little bit more. Basically, if you increase the reversal amount, you're filtering out small changes in price. So let's go to a stock. Let's try Tesla. So here we have Tesla. We got a stock at about $170 roughly. Clean up the chart here. So again, if we follow the rule, I got rid of my calculator. Currently trading at 170. 2% of that is a 3.4. We could round up to 5. I should have kept that. So if I do box size 5, and we'll just do reversal 1. There we have our chart. And basically, every time it moves 5 points in our favor, we're going to get another O if it moves down, or if it pulls back by 5 points and trades at 175 in this case. I'm sorry, not 170, it's 170 because I'm on 5 and we're at 165 right now. Notice you won't see this number, 164.65. That's the current price. It's labeled there, but you will not see an X or an O created until we get to the next 5 points. So at 165, the next O would not come until we get a trade at 160 even. So if this floats around 164, 163, it's going to ignore it. The only way you'll see another O is if we hit 160. The only way we'll get a new column of X's is if we move up to 170. That's it. So again, it's filtering out all this little noise going back and forth in the 160 to 165 level. And it smooths out the trends a little bit more. It's kind of nice, isn't it? So you can even go within, 25 cents, 50 cents, whatever you want. So as I said, smaller boxes gives you more sensitivity. You're going to be seeing more price changes and maybe more buy and sell signals. That's not necessarily good. Remember, going all the way back. Oops, where is it here? Yeah, where's my text? Forgot where I put that label. Gotta really shrink this down a bit. Can't find the text anymore. I know it was on the security. It's weird. I messed up. Oh, I cleared all the lines off, didn't I? Anyway, I was going to say, based on the risk management, we know that if we have more price movement, more sensitivity, we have to reduce our risk with something else, like size or the number of trades we take. So again, smaller boxes, more sensitivity, smaller reversal size, more sensitivity. So to filter out the noise, you want to go bigger. So you avoid the market noise. So basically the way the charts are constructed, let's say we have a chart, we're doing a 1 by 1. So $1 move gives us a signal, and one reversal, a point reversal, gives us the new column. So if we open up and the first price is 22, we're going to put an X at 22 because that's our first trade. The only way we will get another X is if we go up a full point. So if we trade at 22.10, nothing happens on the chart. The only way we get another X is if we move up to 23. And then we place another X on the chart at 23. If another trade occurs at 23, nothing happens on the chart. It just stays the way it is. Doesn't matter how many trades occur between 23 and 23.99, nothing will change. But as soon as we get a trade at 24, now we put another X. And at 24, we go to 25, another X. If we have a $1 move to the downside, if it's less than that, if you only go down by 45 cents and you're trading at 24.65, nothing happens. We're ignoring it. But as soon as we get that 1 point move down with an actual trade at 24, we get a no. If we get a really big drop down to 21, we fill in everything until 21. So we get a bunch, got a bunch more O's there. And that's how it works. So if this turned around and we had a trade hitting 22, then we put a new column of X's. Okay, you don't mix X's and O's in the same column. You always want to put them in new columns as you go along. So right here, you can see this is how it would look. We had a move from 22 up to 25, the reversal down to 20. Then we pulled up to 21, ran up. Again, kind of smooths it out a little bit more. I'm not going to go through all that individually. You get the idea, hopefully. So, like I said, if we're looking at a 1 by 1, we're getting a little bit more market noise. So when there's small changes in price like this, we had a nice move up, a little bit of wiggle back and forth, and then we started dropping. We can filter out some of those columns, which is noise basically, by increasing the reversal size. So if we did a 1 by 3, this would not be seen because it was only a $2 move to the downside. It's got to be at least 3 before it even registers. So we can eliminate some of those columns, again, by increasing the reversal size. And the other way of doing it is increasing the box size. So if I go back to my Tesla chart here, we are currently at a 5-1. And looking at the chart, we got a lot of little noise here with these 1 O's. And, if you were happen to be in a trade, let's say you pick this long and you're down at the bottom here and you keep getting those O's coming in, that might scare you. It might make you nervous thinking, oh my gosh, it's going to turn around. I better get out. But if we change the reversal, increase it to 3, you're not even going to see those. They were wiped out completely. We had the move down and the big move up. So that right there eliminated all those little O's along the way, and we get a bigger picture of the trend. Okay. So you need to decide yourself. There's not one perfect way to do this. I typically do go for the 3-box reversal because I want to filter out things when I'm looking at point and figure. And as a rule of thumb, I try to stick around 2% of price. So if we were looking at the Dow, obviously going to need to change this. We're currently at 33,882. 677, we can either round to 700 if we wanted, or 1,000, or down to 500. Depends on how sensitive you want it to be. So if we do a more sensitive chart, 500, well, this is not going back enough in time. I don't know if I can increase the number of data going back. You can see we're not getting a lot of data here at all anyway, especially with a 3-box reversal. And if I go to 1-box reversal, we get a little bit more data, but again, it's only going back to June for now. And if I were to go even bigger, 1,000, 3-box reversal, we're only getting a couple of pieces of data there. So you got to be careful. Even the 2% is not perfect. Oh yeah, I should go to daily. I think that'll import more data. Nope, doesn't make a difference. Remember, time doesn't matter with these, right? So time does not matter. It really doesn't make a difference what I'm doing there. It should give me more data, but it's not. So whether I have it set as daily or 30 minutes, it's not really doing much. And it shouldn't. Well, I guess it's making somewhat of a change. That's really strange. Oops, I actually want to change that back down. And we could do, let's try 100. Just get more data. There we go. And again, we're on a daily chart now. or daily time frame supposedly, and we can see the bigger moves again on the charts. Okay, so just kind of play around with the experiment to see what's right for you. This does change things a little bit when I go from hourly to daily. As you see, the overall shape is about the same though, and it should not change much because really time should not be a factor, regardless of what I choose. It is changing it just a little bit. Anyway, we can chart broad indices. We can chart Forex. I didn't even look at Forex. Let's go out to Euro US dollar. There we go. And it says no data here. I may have to change this. Oops, let's go to daily. See if that helps me out. Nope, still no data there. All right, we'll go back. For some reason, it doesn't like that on this one. But there should be a way to be able to chart the data for Forex with point vigor. It should be fine. You know, as long as you have price information, you should be able to chart it, period. But again, I was saying, you know, for the bigger indexes, you probably want to go with 2% rounded down to the decade or century number. So the decade numbers are the 10, century numbers are the hundreds, and use a 3-box reversal, typically for the large indexes. And again, you get to see the trend better. If we go out to the NASDAQ, we happen to be on a 100-box 3 reversal. Go ahead and clear this out of the chart, and we will not see as much noise. Even on a daily chart, if I were to go back to the candlestick, you see all these little moves back and forth. But when we go to that back to that point figure, this is at 100 by 3 on a daily chart. You don't see all those little wiggles anymore. We had the big move up and a bit of a correction pulling down. So we actually had enough to correct after the breakout. Anyway, we're just trying to look at bigger trends altogether with this. Well, if you're looking for the buy and sell signals, there's different ones you can use, by the way. You can use simple signals or you can use more complex signals. It's entirely up to you how you want to do this, obviously. Sorry, I was just checking something here. Okay. And a simple buy signal is nothing more than if you get a new column of X's that rises above the previous column, you buy. That's it. If you're moving along in your X's and you get an O column that breaks the previous low of O's, you close along and go short. And that would be an always in type of system. Not necessarily the best kind of system out there, but if you're interested, you can do that. Okay, it would keep you in the markets constantly and only exiting when you get a reversal. So for instance, we have, if I go back a little bit here, there's a sell. So you're short. Came up a little bit. Nope, we're still short. We're still going down. The reason why that's not a buy, let me pull this back so we can see it in real time. Okay, so you got a short signal there. This is not a buy signal just because you have X's. It's got to go above the previous column of X's. We didn't do that. So you'd still be short. Good thing. Now we do pull back and you're out. Now you didn't get out at the absolute bottom, of course, but that's still profitable right there, isn't it? If I can move this line up, be nice. Let's snap. That's why. Right there is your stop out from the short. In at 12.3, out at 11.8. Again, profitable, and you go long there. Well, there's a pullback. It didn't break the column of O's, so you're still long. Now you're out, and that's a loss. And the reason why is it pulled back. You know, nothing's perfect, obviously, and we may want to use more advanced signals to figure out a better way of trading the trend. So now we're in on the short side. Unfortunately, we turn around right away, and that's an exit for another loss as you broke above the X's. Now you're long. No exit yet because we didn't break the O's. Still long. Out again. And you can see this is whipsawing pretty bad back and forth. Another small loss. Actually, that's flat for the most part. In order to go long, we have to break the X's. There we do. And we would still be, oh, no, we'd be out of our longs now. And you can see this is not a great system necessarily. It can work when you get good long trends, but when you go back and forth like this, the trend changing, it's going to eat you up. Obviously, if I go back to that Tesla, and I can use any signal or any security, it doesn't really matter. But again, we were going down to, I forget where we were on this. Was it 10? That could work. Should go smaller. Well, I guess it's fine. But again, sometimes you get whipsawed back and forth, and that's where we can introduce the trend to make sure you're filtering out some of these trade signals. But when you have a nice long trend, it should keep you in. As a matter of fact, back here, you have that move up. There's a long, never got a sell signal until up here. So you would have been in on the long at this point, out of the long right there. And that was a nice move of about 250 points. So when you catch a nice trend, it can definitely keep you in the trend rather than scaring you out where you see these little bits of O's. A lot of people might have gotten shaken out during that. Meanwhile, you could have gotten in June of 2020, held on until December of 2021. So a nice long trade capturing all 250 points. So again, you got to keep an eye out for the bigger pictures, bigger trends. That's just the simple signal. There's certain patterns you can look at too. And a lot of people will actually use these for the patterns. They're a little different than they are in candlesticks. Typically, when you see double tops, or in this case, a triple top, you would think markets are going down. In this case, it's a breakout and it's a signal to go long. So this is the reversal of a downtrend typically, where you have two peaks of X's at the same height, same price level, and then you get this column of X's that breaks out. So the breakout on the third X is the signal to buy, especially after a long downtrend. This is usually going to see a big reversal in price. I don't know if I have an example. Maybe if I go smaller box size here. No, got a triangle. Yes, you can use stops and targets as well. I haven't gotten into that yet. I have not covered that yet, but I will. Nope, I don't see any triple tops or triple bottoms yet. Anyway, it's not always easy to find the patterns because they don't always happen. I mean, they will happen. It's just a matter of finding them. So triple bottom is just the opposite. Obviously, you get a column of O's, a second column of O's that's the same low, and then on the breakout, on the third move, that's your signal to go short. And this will usually reverse a long-term uptrend. Prices are fighting, they finally break down. Asymmetrical triangle, I mentioned there was one of those that just happened. These are typically continuations of trends after consolidation. So usually, almost always, except for when it doesn't, that's the problem with technical analysis. It doesn't always follow through 100%. That's why we have to play probabilities. But when you see prices, didn't mean to do that. When you see prices consolidating, it's most likely going to continue. So when we go back here, this one actually was a reversal. I noticed the symmetrical triangle. Nope, it wasn't quite. Maybe. You notice that consolidation right there? And we ended up breaking out, retesting, and going. I don't know if I have another example. No, it's a reversal. Right here, oops, that one. Started consolidating, broke out, pulled back, and then went. Unfortunately, there's a little shakeout there, which is not good. That might stop you out. Although, no, it shouldn't stop you out. Remember, we never went below the previous column of O's. So if you bought the breakout of the triangle, did not stop you out, you would have been in fine and rallied. So we'll look for the stops and targets again and talk about that as well. But these are just some of the patterns that you might see. Symmetrical triangles are normally continuation, except when they're not. We also have ascending and descending triangles, just as you would in candle patterns, where you're basically flat and finally break out. So this is just hitting price resistance over and over and over again. And when you finally break out, the signal is triggered to go long, just simply going above prior X's. That's it. And the higher lows just show you strength. So let me go over to Let's try crude oil. And I'm definitely going to need to drop the number here. I'm on box size 3. Let's just try $1. There we go. And we clean this chart up. And we had a continuation on a symmetrical triangle right there. We even had, well, wasn't the best necessarily, but this is a triple bottom right there. 1, 2, there's the break and the short signal. Notice never gave you a buy signal because you have to have a new high on the X's, and it didn't. Kept you in until right there. So again, missed the bottom, but there's other signals you could have used to get out. But that was your triple bottom and the breakout buy, or sorry, short sell, and there's your exit. So it was successful, 66 down to 53. Now the symmetrical triangle I was just talking about, it's right on the right-hand side there. So what we need is the breakout for the buy, and there it is. It's a pretty nice one, wasn't it? Good breakout. Actually, let me get rid of the indicator for now. There we go. And there's your sell signal to exit, if you didn't already. So in at 67, out at 80. Nice. And of course, the descending triangle will work the same way. It says symmetrical. You just have a flat bottom. You're basically waiting for the breakdown. You're seeing lower highs that shows weakness in price, and it breaks down. Now, remember, it could break out as well. It could go either direction. Okay. So when you're looking, this is your target answer. There are what are called horizontal price projections, and there are vertical price projections. The vertical ones are a little more complicated. I'm not going to go into those right now. But the price projections do not have a time frame. The horizontal ones are relatively easy in order to identify and really use even. However, they typically work best on 1-box reversals. They don't work as well on the 3-box. So again, you're looking to be a little more sensitive to price changes by going down to a 1-box reversal, right? It's going to change the way we look at this here. Still not bad. Let me clean this chart up again. We're on crude oil, $1 move, and it's a little noisy. So again, if I want to reduce the risk and the noise, I can increase this to 5 for the price change. That's too much. Let's try 3. Yeah, still not quite where I want it to be. I want to be able to make trades. I might just have to keep it at 1 and deal with the noise. 2 is okay. Yeah, I'll just do 1 by 1. That's fine. I mean, again, technically, we're supposed to go, we're about $80. So about 2 would be the answer, right? To round it up to 2, because that would be 2% of price, roughly. Doesn't have to be exact. So let's do that. We'll just do 2. 2 by 1. There we go. All right, so now what are we going to do here? Well, we're going to take a look for horizontal price projections on our 2 by 1 crude oil chart. With the horizontal price projection, you got to find an area where prices were kind of moving sideways, congesting. So in this case, it's right in here. You see a sideways movement in price. We got some X's, we got some O's, price above and below. Count the number of boxes in the row. If there's any empty boxes, let's say, for instance, the O's were not here, they were down a little lower, you'd still count it. So in this case, we have 1, 2, 3, 4, 5, 6, 7, 8, 9. All right. So 9 boxes in a horizontal row. And that you basically look for the middle of the congestion, count that box. And you just add that number to your row for your target. That's it. So there's a price target on a horizontal move. And then you wait for a buy or sell signal. By the way, this projection could be either direction. So if we got a sell signal, we would short. If we got a buy signal, we would buy and target that 9-box move. That's it. Let's see, does this one have a signal? There it goes. It went down. We got a new column of O's. There's your sell signal where you broke below the previous O and you met your target. It actually even kept going. If you wanted to put in a trailing stop, you could do that too. So if we're looking Crude oil doesn't have good congestion at all, actually. I mean, the closest I have is, it's not even congestion. Right now, we've got congestion. In this case, we've got these two rows of congestion, and we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19 boxes. So if we're going to project, we'd be looking at 78 minus 19 gives us a target on the downside of 59. Close enough. And 78 plus 19 would give us 97 on the upside. Now, remember, there's no time limit for these being met. It's just the overall price target that if prices break out, we would buy if it breaks upwards or sell if it breaks downwards. Now we have price targets for ourselves. We could also maintain a 3-to-1 reward to risk if we want to by seeing where we're, well, unfortunately, right now for the sell signal wouldn't occur unless we broke 67. We got to trade at 66, and that doesn't give you a lot of profit. And right now, if we wait for a buy signal, it would occur at 83. That still gives you a decent reward up to 97, 14 points, right? And just divide by 3 and put in your stop. So that's one way of doing it, 3-to-1 minimum reward risk. So again, our buy signal would be break out of the X's. Or in this case, we have O's right now, we're on. We have to, this is not going to work. Obviously, we'd have to wait for that breakout. So hopefully it would give us another column of X's before it gave us another column of O's for the sell. And we can look at another example. Let's see, what can we do? I want to see if I can get currency to go. There we go. I must have typed in something wrong. So now on the box size, again, if I try to do 2% of price, we're currently trading at 1.24294. It'd be basically 25 pips. See how that works. And I'll clean this chart up. There we go. Not too bad, right? Looks like we might have something here. Excuse me. Well, most recent congestion, I would say, was right about here. And if we had congestion here, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 boxes. So if we break, I would count 15 from that area. Okay, so again, each box, wait, did I do one box? Yes, one. Okay, so each box is 25 pips. So you're definitely going to want the calculator there. If we were trading right here, 155, no, actually it was a little bit below that at the time. There is 152.5. So basically we're looking at, I said 15 boxes times 0.025. That's 0.375. So let's subtract 1.525. Gives us 115. Is that correct? I don't know if I did that right. 1.525 minus 0.325. Or was it 350? Yeah, it was 1.5. I'm sorry. I swear I'm an idiot sometimes. 15 times 0.025. I just couldn't remember. 375. It was 375. So 1.525 minus 0.375 is our target of 115. That's what it is. So when we get the sell signal there, there's the sell signal. We would actually have a target of 1.15, was it? Yeah, which is right about there, roughly. And what happened? It made the target. Took it a while, but it made the target. So we got in at September of 2015. It didn't hit the target until January of 2020. So a little long there, and you probably would have been stopped out. As you see, the X's there, higher X's here. So it would have been tough to actually get there, but it did, and actually exceeded it just a bit, but not by much. But notice when it hit the final target, it bounced pretty sharp. So it does work. Again, you got the horizontal price projections, and then you simply wait for your buy or sell signal after that projection. Another one is, and again, the area of congestion. And you look at the middle of that, and you do count the number of boxes again. Actually, I'm sorry, at the beginning of the congestion in this case. If we're looking for a move to the upside, this whole area of congestion, I'm not counting this stuff down here. It's just this area where there's wide number of boxes. You go to the bottom of it. And in this case, there were 8 boxes, but now we're on a ×3 chart for the reversal. So you got to multiply by the reversal size and project. If we were looking at shorting on a sell signal, you would have gone to the top of the congestion and projected down from the top of the congestion. So basically, if you have a multiple for your reversals, you got to use that in your projection. So in this case, the target was 24. And in this example, it actually just took off. It didn't get there right away, did a little pullback and eventually got there. So if I go back, let's see. Let's do Apple. I'm just picking random securities. And we're at $160. So again, we'll stick to the rules. 166 times 0.02 is about 3 points. And let's say we want to do a 3-box reversal to filter out some noise. There we are. So, didn't have a great congestion. That's what I'm looking for, is a congestion for a good measurement. Let's try a smaller box size, see if we get something. We'll just do $1. And refresh. Well, it was a symmetrical triangle that gave us a breakout right here. Oops, there we go. So if we're looking at the congestion, it's right in here, longest part of the triangle. We have 1, 2, 3, 4, 5, 6, 7. But remember, we have to multiply by 3, which is our box reversal size, because we're using 1 by 3. So instead of 7, we're going to be using 21. And we're going to project from the bottom of the congestion. That's this row right here at 120. So we're looking at 141 as our target. That's all. Buy signal comes right there as you break above the prior highs. Got a little scary at first, but we never got a stop out. It just came right back. And there it finally exceeded the target in this case. So once again, we get another symmetrical triangle there. Could look for another breakout. Oops, wrong one. It's right there. And again, we could possibly project using this as well. We have 1, 2, 3, 4 only. And we project from this bottom row right here at the bottom of the triangle. But again, we're not doing 4, we're doing 12 because we have to multiply by the reversal. So we have 145 plus 12 be 157. I do that right, hopefully. Yeah, pretty close right there. Buy signal. Almost made to the target, only got to 156. You kidding me? 1 tick away or $1 away from the target. And of course, it gets stopped out on the next one. But that's how it works. Relatively simple. And, it's never going to work 100% of the time, but it works pretty well. You can see if you participate in this move to the upside where you got the buy, you never got stopped out until way up here when you finally got a new column of O's. So anyway, suggestions for stops. You asked about that. You can always do a 3-to-1 if you got a large move, or, you put your stop below the X's. I'm sorry, below the O's if you're in an uptrend, because that would be a reversal, or above the X's in a downtrend. The X's and O's are one day? No, not necessarily. No, this could be multiple days. Remember, time has nothing to do with this. This is November 26th. This is November 29th. Then we skip to Friday, the 3rd of December, Monday, next Monday. So no, it's all random. Time has nothing to do with it. You can ignore that bottom other than knowing when you got in and when you got out. But this is not a normal x-axis like you have on candles. Time means nothing with these charts. You're just simply looking at price movement. That's it. So like I said, when I switch from daily to hourly, you really don't see much of a change here in the chart, do you? You shouldn't, because this should be based on price, but it's asking when the price changes and hits certain levels. That's all. Whenever a trade hits a certain level, you get an X or no. And some of the same stuff applies when it comes to the charts that we saw before. I'm not going to get into all the details right now, but you can see we had a big reversal right here. Prices were rallying up sharply and dropped. That was the start of a big supply zone selling pressure, and that's where you reverse. If we look for, actually down here is probably a good area for demand, buying pressure. And look at that, we bounced. It worked. So same kind of concepts can apply with supply and demand as well. And if you get a large move, don't stay in forever. Don't put your stop way, way down. If you had taken this long move up, you don't want to wait for it to pull back to get you out. You can just get out whenever you get a 3-box reversal and lock in higher profits that way. That's what that's saying. You can put in a trail stop wherever the 3-box reversal would occur. So if you're in an uptrend, we might buy right here. Oops, what happened there? It's not updating properly. Basically, right here would have been our buy entry as we broke out to new high X. You place your stop underneath the most recent O. When you get an O column pulling back a little bit and then a new X, as soon as you get the new X's, you move your stop up. And you just keep moving your stop up above the new column of O's every time you get a new X column until eventually you get stopped out. That's it. Or you hit your targets, obviously. In the downtrend, same thing. Here's a sell entry because we broke the column of O's. Our stop would initially be above the X's. But as soon as we get a new column of X's and then start our new column of O's right there, you put your stop above the X and just keep moving it down until eventually you get stopped out or you hit your target. And like I said, on a 10-box move, for instance, here we broke out above prior column of X's and we buy, or out of this little triangle or flag, whatever you want to call it. Initially, your stop is below the O's, but when you get all the way up there, you get 10 boxes. You don't want to give back all that profit. So you move your stop up, basically put it wherever you would get a 3-box reversal. So 3 X's down is where your stop goes. And as prices continue to move up, you keep moving the stop with it until eventually you get those column of O's and it stops you out. That way you don't give back profits. You want to let the winners run, but you want to keep the wins. And you should always maintain a 3-to-1 reward to risk. Hopefully, at the least, you can hopefully do more than that if you can, obviously. So just calculate, where you're getting out, where you're getting in. For instance, here, 1-to-1, we have our counting row in this sideways congestion. So I can count and project. I can also put my stop below the column of O's and make sure I have a good reward risk ratio. We're buying on the breakout of the prior X right there. So we can measure our risk and make sure that it's a minimum of 3-to-1 for the risk versus reward. In this case, it is 16-to-5. Another thing I was mentioning is trend lines, trading the trend. I didn't mention it. I'm saying trading the trend. One of the things you could do is draw trend lines at 45-degree angles from highs or lows. So going back to my chart here, for instance, this is Apple. Clean this up. If we have a major high or major low created, let's see. Well, this was originally a big high right there. You always put your, and you can adjust it obviously, but you want to put the trend lines at 45-degree angles. And once the trend is violated, you stop trading in that trend direction. So for right now, there's our bottom. There's my 45-degree angle right off the next X. As long as we stay above that, I should be bullish. And maybe I ignore sell signals and only go long. We had to put in another low right here, 45-degree angle. We had that nice little triangle. We broke out right there, the triangle. That would have been a nice buy right here. That's your entry. And I could have put in the stop just below these O's. If I was doing measurement, 1, 2, 3, 4. Okay, do we have a 3-box reversal? Yes, we do. So that's 12, right? So from 53, we would add 12, that's 65 for the target. We obviously hit it right there. But that wouldn't have been a good reward risk ratio for the 3 to 1. That's the only problem. We only got about 2.5 to 1 to the measure move. So got to keep an eye out for that. Anyway, you can do those strategies. If you're permanently in the market, you buy when you get a buy signal, you sell when you get a sell signal. But to reduce your risk, only use the simple signals for exits, and you can use the complex signals like patterns for the entries, and you can always just trade in the trend direction. So if you get buy signals, you enter long, but sell signals, you just exit longs, you don't go short, or vice versa. If we're in a downtrend, you only use the short signals to enter. The buy signals are just to take profits on your shorts. And typically for stop losses, you just look for the reversals. If you break the prior columns, you get out. So you can keep it relatively simple if you want to. You can obviously complicate it if you want to as well. It's not a good thing to do, but there are a lot of different strategies that are out there. And I do have more details in the E-mini think tank about this, and I can go over it a bit more in there as well as the vertical targets. There's a more complicated way of looking for some of the targets and giving you a little bit more accurate targeting. Like this graphic, thanks. So there are different strategies. Again, you buy or short after a 3-box reversal, after breakouts. You can, again, look for the trends altogether, but make sure you set stop losses no matter what you do, and try to maintain that 3 to 1 reward to risk ratio. Okay. So that's what I've got for you guys today. As I said before, I've got a lot more detail and trade information, as well as get to employ this in live markets in the mini think tank. So if you'd like to join me in the mini think tank, again, you can email us at support@wealthbuildershq.com. Actually, I was looking for this page. So I'm going to put up a link for you there. Close that. And where the heck is it? There it is. I was going to try to put in the link here for you as well. I think I got it all. So if you're interested in joining the E-mini think tank, there's a little bit more information about it right there. Tic-tac-toe, interesting. Yeah, it is kind of like a little tic-tac-toe there. Oh, thank you for the previous numbers. Thank you on the history for the calculator. I appreciate that. So the recording will eventually be in our YouTube page. If you go to Wealth Builders HQ YouTube page, we post them up there. I'm not sure. I don't control it, so they will put it up eventually. But yeah, so I want to thank everybody for being here. I got to cut out. I got to go to a meeting. So I will talk to you guys again very soon. And hopefully I'll see you in the E-mini think tank. So have a great weekend. Trade safe, trade well, everyone. Take care.